Hi, I wanted to start with that I'm going to get to this future value of all your income being put into your own banking system. But before I get to that, I just want to share a couple things that I was having a conversation with a friend this morning. And as we head into the holiday, Independence Day, July 4th, I said, honestly, I don't even remember that we've got July 4th coming up because my family had a loss 11 years ago on the morning of July 4th. And we try to be together, uh, just be together on the July 4th. But I don't really think of it as a holiday. And I work for myself, so I don't think in terms of I get a day off and that kind of thing. But I do talk about independence every day. That's what I'm trying to do with um, the concept of becoming your own banker, infinite banking, and creating your own banking system. So, you can be independent of the banks in the sense that when you need financing, when you want access to cash with no questions asked, you have it and you don't have to be beholden to the banks for giving it to you. We still need them for transactional purposes, paying bills and buying food and everything else. But we don't need to store our money there. We don't have to keep it there. We just need to cash the payment or have the deposit, and then we can move the money. And Nelson Nash of the book Becoming Your Own Banker, there is a section where he's talking about getting all of your income into a series of policies. It's not going to happen with your very first policy, but the goal should be to try to get all of your income in there. And, I work with clients and, they'll do a policy. And we've had this discussion about the series of branches of your banking system. But it's pretty rare that they come back to me and say, I'm ready for the next one. It does happen. And I've done it. I've created multiple branches of my own banking system. But hopefully this hits those who've never heard about this, and even my clients that might watch this, that they should be considering as their income increases and exploring ways that they can get more money into branches of their own banking system through permanent whole life insurance. Back to sort of this idea of independence. When I was talking with a friend this morning, I said, the Senate passed this big, beautiful bill. And this isn't me picking, I'm an American. I don't pick sides of the aisle politically. But I do want to talk about what makes sense. And, whether it be one side that's in office or another side, and you're supportive of President Trump, um, he started this whole idea of tariffs, of making America great again, bringing jobs back to America. He brought in Elon Musk to do the DOGE exercise, as I say, because I don't really know what's coming of that, other than, Elon's no longer involved. And so I said to this friend, what does the GE stand for in DOGE? And he thought for a minute and he said, uh, and then he said, tell me. And I said, government efficiency. And I said, there's no, that's a total oxymoron, like They don't go together. It should be called DOGE, Department of Government Inefficiency, because we know that there, is a lot of waste with government, and we get bloated in the size of it and the amount of employees, um, federal employees. And so, I'm looking at trying to help you in your own personal life become more efficient, and creating one of these uh, branches to start with is the very first start in trying to make sure that your use of your dollars is most efficient and effective. And so I'm going to go into this future value of income. I'm going to share the future value calculator. And I want you to think about the fact that if you had your own bank, um, and you could put the money in there from your income, and it would never go away. It would only grow in size. And when you were in need of whatever large item that needed cash, which there's all kinds of things. It's just use your imagination, everything, right? And when you wanted the money, you just used your cash in your own bank as the collateral for you to borrow the money, because you're going to pay interest whether you know, pay it to somebody else or give it up by taking your own cash out of the bank, for example, a commercial bank. But when you're leveraging, using your cash as collateral, you're not actually taking your money. So your money still sits there and grows. But you want it in a bank account that's paying at least, hopefully close to the level of inflation, to offset some of that, and offset, some of the costs of borrowing. But you're going to borrow one way or the other. You're borrowing from somebody else, or you're borrowing from yourself. So if you were borrowing from yourself and you took your own cash out of the way that people live today without having a permanent whole life insurance policy as your banking system, you take the cash out and you pay for something. That money is now in somebody else's hands. It's no longer in your system, in your personal economy, and getting a return for you. So it's not continuing to grow. So you've given up that cash, and that's not efficient. And so when it comes to this big, beautiful bill, I'm bouncing a little bit here, but I'll get to the future value calculator in a moment just to show you what I'm talking about. But back to the big, beautiful bill, um, we're talking about a debt ceiling, meaning how much debt can government actually accumulate? And they keep raising the level of how high it can go. And in the big, beautiful bill, they have said we're going to raise the debt ceiling by $5 trillion. $5 trillion? I mean, that doesn't sound very efficient. That doesn't sound like you're reining in spending. That doesn't sound like you're gonna cut wasteful spending, and become more efficient. So if we're gonna be independent, we have to start thinking independently and think about, how do I keep my own personal economy in good shape as the country decides to collectively support what our president is doing. And whether you feel like you're personally doing that or not, you are doing that, because if you're not coming up with a solution to combat what these representatives are doing, with your voting power, with your involvement, this is what we have, and we're going to have inflation. That's what's going to happen. If you raise the debt ceiling, that means, oh, we can take on more debt. And that's why trying to pass this bill so they can take on more debt. And when they take on more debt, well, that means there's more money sloshing around, chasing the same amount of things. And that's ultimately what inflation is. I mean, the same supply of things is available, but now the money, the numbers, the dollars are the demand. And the demand is this, even if it was the same, well, those with the most amount of money are the ones that are going to drive up the cost of houses and cars and all kinds of things. Um, and whether we have a crash in any of the markets, real estate, stock, um, we are going to have inflation on the things we absolutely need when we keep creating more dollars because they're going to be chasing the supply that's available, and that drives up the cost when there's a limited supply. There's not an unlimited supply of things being created. And if not that we can't, and that there isn't an infinite amount of supply that could be created, we are going to be chasing with the dollars that we have. And if we have more dollars, we say, well, I'll pay $100 for that loaf of bread. Oh, no, no, no. I'm sloshing around $105 that I'm willing to put towards that loaf of bread. And that's how the prices start to drive up. But that's just a little aside that I wanted to talk about as we come into Independence Day. But I do want to show, let's see if I can get to my share button here. And I do want to show a future value calculator that, let's say you're 30 years old and your take home pay annually is $50,000. And I'm going to say for 20 years, I'm going to start with zero. I'm going to say I'm going to get in my own banking system, I'm going to get a 4% interest rate. And then every year for those 20 years, I'm going to keep putting in my $50,000. Probably going to do it every 2 weeks. I'm not saying you're going to start out with this, but I want to show you what this turns into at a 4% interest rate. And so we're going to put the 50,000 at the beginning of the year, every year. It really doesn't matter if we do this monthly or we do this annually. It comes out to about the same. So after 20 years, you have this $1.5 million. But what I want you to realize is you have access to leverage the money in the end balance. Now, when it comes to your permanent whole life insurance, there is some cost for the insurance, but at least half of this is available the first year, 52,000, so 26,000. More than half of it will be available of this 106 the next year. So let's just say it's 60%. So, 56, 53,000, I think 53 or so, times two, sorry, 53, 60% of that would be 63,000. So now you have access to 63,000. Maybe you got 70% of this 160. So now you've got access to 100,000, and it keeps going up until about year 8. You'd have access to leverage every one of these dollars. So what I'm trying to point out is it's not just this end game of 20 years from now that I'm going to have 1.8. I've been able to leverage some of this money when I want to buy a car, put my kids through college, take a trip to Italy with the family for, a couple weeks, whatever it may be, and your money keeps growing. And this is just for 20 years. So every year, year 15, if I'm borrowing and then I pay it back at my own leisure, whenever I want to pay it back, but I paid it back, I have access to all this money again. I can leverage it again. I can use it as collateral again. And I want to say, well, okay, well, you were 30 years old when you started doing this. How about if, you know, we push this out 30 years? I do the same thing for 30 years. So now I'm 60 years old. And instead of what I showed you earlier, I mean, I'm still putting in the same amount of money, but I'm doing it for a longer period of time. Now I'm 60 years old and I have access to 2.9 million. Now people are living anyways. They're borrowing from banks anyways to buy houses and to pay for all these expensive things that they want and need or feel they need. Um, that's going to happen anyways. But if I'm going to pay it back anyways, why don't I pay it back to myself? And so instead of just chasing, throwing some of my income every pay period into the stock market, chasing 8% and so forth. And I'm not saying don't do that, but just simply by doing what you do with the banks today, the commercial banks, if you found a way, and whether this is you or this is you teaching your children or both, but certainly what if you could teach your children this from the very, very beginning so they get a job when they're 16, 17, 18, and maybe they even start working with you, and like when you're giving them a paycheck, and you own your own business, and maybe they started getting some income when they were 12, like, and you taught them to create their own banking system, become their own bankers, right? Then when they go to buy their first car, when they go to buy their first property or put a down payment down, whatever, they have access to this liquid cash. So as you can see, all those years you had access, and then when you paid it back, let's just use an example. At year 10, let's say you took out 124,317, so you got 500,000 left. If you pay back that 124,000, and let's say it took you 5 years, not only have you paid it back, you've been putting in this 50,000 for five more years. And so now you have access to over $1 million. That's the power of creating your own banking system. And again, this is going to be a series of policies. You can have more than one policy on yourself as long as you qualify with, you make the kind of money that it takes to get approved by your income and what your annual premiums will be for your life insurance, and you're healthy. And if you're not healthy, then you find insurable interests. Your spouse would be you have an interest in their insurability. So you can put a policy on them and use them as the creation of the platform for the banking system. You can put policies on your children. You can be the owner, of the policy. So you're controlling. You might be you're putting in the money, you have access to leverage it, to use it as collateral. And this is what I'm trying to share with people is when you look at this, and of course on a podcast, you're not going to see it, but go to the YouTube version of this podcast and you'll see the visual. And that's about it for now. And if I don't have another video between now and then, I wish you a happy 4th of July with your family and friends, and appreciate you watching. And we'll stop that, and then we'll end the video. Thank you.